In this episode of Net Lease TV on Tour, we interview a summer all-star net lease panel. We interview Richard Hurd, Hurd Development, Dan Lewkowicz, Encore, Jesse Limon, Marcus and Millichap, Pam Goodwin, Goodwin Commercial, Matthew May, May Realty Advisors, and I'm Chris Marabella, the moderator of Net Lease TV. Enjoy. All right, guys, welcome back to Net Lease TV All-Star Summer 2026. And we've got the All-Stars here. I'm glad you guys could participate in this event. Got some great questions. There's a lot going on. We've got the oil prices right now. Brent crude, 87.59. 10-year treasuries up to 471. And consumer sentiment just came out at 51, down from 55.2. CPI is still falling at 3.4. So it seems like, inflation's kind of getting tamed other than the price of oil. If you saw my newsletter, that was the biggest component is oil and energy with as far as inflation is concerned. So let's start out. How do you guys think the midterms are going to affect net lease properties? Does anybody want to chime in on that? What is going to happen with the midterms? Is it going to be kind of like 2020 again? And how will that affect net lease sales?
Yeah, Chris, I could go ahead and take that. I think that's a great question. I mean, historically, midterm elections, breed a lot of uncertainty. And I think that's the most important aspect here because capital tends to sit on the sidelines until the outcomes are clear, especially on issues like tax policy, 1031 exchange, bonus depreciation, corporate tax rates, et cetera. However, I do believe that net lease is more insulated than other aspects of commercial real estate because of the long-term leases and credit tenants, and it's less affected than some other forms of real estate. But I do expect maybe the midterm elections to have a little bit of a pause, on transactional volume, and then to pick up once we have a little more clarity.
And normally, Dan, you see like July and August seasonality. Net lease properties kind of slow down. Most of your buyers of the net lease, like the Richard Hurds of the world, are maybe on vacation. They're on their boat. They're flying in their Learjet, whatever it may be. So to get their attention is always hard. Do you think there's kind of an aberration right now in the economy where it's just kind of soft? What are you guys seeing out there with the economy from your standpoint?
I speak for me in our market. I mean, is it slow down? Yes, because people are on vacation, but I don't think it's enough to move the needle. It's really a matter of what's the mindset. Because if people are leaving town, some of the investors go, "That's great. That means there's less competition for the deals that we're looking to buy." But it's not enough that's going to go, "Wait a second, I'm going to take a month off and not worry about it." Because you got to be buying for the long term, not the short term.
One thing that I'm seeing is a lot of people are coming to us to refinance, and they're basically upside down. They got to come to escrow with some cash to pay off their old loans. So all the principals are kind of going through this exercise. Okay, do I refinance? Well, maybe I don't want to come up with some cash to pay that old loan off. I think I'll go ahead and sell the property. That's what Jesse and I are seeing. Like we had one client with a CBS, and she went through the exercise and she was saying, maybe I could refinance. Well, her cash flow went down. She was getting much more. I think she was getting like $150,000 a year. And by the time we figured the refinance, she would only make $70,000. And the only way that we could have got her close to her other loan is do a CMBS loan. And then she said, I don't want to go. I don't want to pay all that money. And that's when she decided to list with Jesse. Are you guys seeing anything like that where, people are going through the exercise to refinance? They go through it. They look at their cash flow. They look at the cost. And it's like, I don't want to really do this. I just want to sell the property, get my cash, and move on.
Yeah, definitely. Especially I seeing it a lot in the former pharmacy space. Not only with refinances, but a lot of lenders have restrictions on who they will allow their borrowers to lease to, a laundry list of tenants that they're not interested in. And then you come across, a similar scenario, Chris, what you mentioned in terms of doing the cash out refi. But even if they are to lease to a different tenant, many cases these assets had above market rent. So once you bring in a tenant that's not able to pay anywhere near what the Walgreens or the CVS or the Rite Aid was paying, a lot of times those borrowers are now in default of their debt service coverage ratio covenant, and that forces their hand to have to sell.
I think that the banks are coming to the realization, or the principals have been kicking the can down the road, and it's coming to roost now. And it's like they got to do something. I've got another client. We're trying to refinance his 3 Walgreens, his Dollar General, his ATT deal, and a Walgreens with a Family Dollar sublease. And that lender, we had to send them our loan broker agreement for them to give him one additional extension. Then Jesse and I have another client that we're working with, same kind of situation. We're having to give Jesse's listing agreement to the bank to allow that client to get 1-year extension. So I think that the banks are now saying, hey, we want our money back. We've given you time. We've given you these extensions. There's a lot of distress out there, kind of what I'm seeing. And really the transactions that I've been involved with like Jesse and myself, there's been a lot of distress. I just closed the 2 Dollar Generals, and that sponsor was in the same situation. He sold the Walgreens, and then he rolled into brand Dollar General deals that I did perm loans. But he was a little bit distressed on his properties that he was selling. So what do you see, Richard? What do you think are the hot spots out there right now for development? If you were to go into an area, what areas of the country, when you were at ICSC, and if you went this year, what do you see out there as the hot states to do development right now?
So for us, we're regional.
Okay.
We're not nationwide. We're Midwest, Southwest, and Southeast. We don't cover the Northeast at all. So I can't speak to those markets. And so for us, it's the Sun Belt is really where the activity is for us. Whether it's Arizona, Texas, Florida, Colorado, Nevada, that's where most of the activity is. It's where people are moving, and that's what's driving retailers to want to build. The problem we have is that in the Midwest, the demographics are basically stagnant in a lot of markets. Not every market, but a lot of markets. So the middle markets, the Des Moines, the Omahas, those places, really not growing much at all. So the growth is in those markets. What we are seeing, though, we're seeing a lot, and it's early this year, the bonus depreciation buyers have already started to come out, and they're wanting to buy. They're wanting to buy convenience stores and car washes and things like that. So we just put one under contract a couple days ago, a convenience store. Car washes are coming on. I mean, it's early. Usually it's not until after Labor Day do we start feeling that type of pressure. So that's what I can tell you.
Who's the C store occupying, if you can mention that? Is it a 7-Eleven or Wawa?
No, this is a Maverick. I mean, we have probably 5 or 6 different brands that we have Casey's, Mavericks, Quick Trips, Moto Marts, Circle K's, and we'll trade any of those. But the bottom line is that I don't think it really matters the brand. When the bonus buyers really get into gear, they're really focused on term, location, and just getting that big bonus depreciation value before the end of the year.
Richard, how do you manage the risk of cost on your project when you've signed a lease? Maybe, I don't know how much lead time you need when you sign your lease, you're locking in your cap rate, and then you're going out and you're getting your subs and your general contractor. How do you manage that risk if costs are going up, or do you? Or do you have such a buffer that
No,
you're okay?
I wish I had a good answer for that. It used to be that we had a pretty good handle on what costs would be for construction and what capital costs would be. In recent years, I mean, that's all out the window. It's difficult because, well, obviously capital costs have been doing nothing but going up, and construction costs went up right after COVID, and they really have not come back down. And so it's tough to do. I mean, we just have to try to guess the best we can as to what those things will be, and hopefully when we're done, we're making money. But it's a more tenuous process than it used to be.
I remember in a while back, I don't know what year this was, but a developer told me they did a formula deal where they locked the cap rate in at C of O or something. Have you ever heard of such an animal where you lock the cap rate down the line, not at the beginning, and it like is over a certain index, so that if the 10-year treasury goes up, your cap rate goes up, and then it's locked at the end? Or have you ever heard of such an animal?
Heard of it, never done it. It's just, I think lots of different companies are trying different methodologies to try to get things built. And a lot of them are laying it off onto franchisees. I mean, that's what you're seeing with all these coffee deals. Seven Brew and those kind of guys, they're laying the development risk off on the franchisees. And, I think that's working for them. And the franchisees have enough margin that they can absorb the difference in construction costs and interest rate probably better than a developer can.
Does anybody else have any questions for Richard? He's one interesting person, that's for sure. He's really successful. Done a great job, Richard. You and your not only in business but your family also. Anybody have any questions?
I have a question.
Richard? Go ahead,
Chris. Are you seeing any like for the small drive-throughs or larger ones, adding solar to the projects, whether it's a drive-through and building a canopy so it's more comfortable for the customers in the heat, plus being able to reduce their operating cost?
I haven't seen that. We did a Chick-fil-A in Las Vegas last year, and there was a lot of conversation around those types of subjects because, well, maybe we can add some solar and reduce our energy costs. And I don't know, man, there's like a 75 car drive-through we had to do. I mean, it was ridiculous, but they pack it in so much. I honestly don't know that they're as worried about that. The big producers like Chick-fil-A or In-N-Out, because they just do so much volume, I don't know that it matters to them. It's probably the smaller operators that would have a bigger interest in that because operating costs are a bigger issue for
Pam Goodwin. I know that you were doing development at one point, right? I think you did some Walgreens, didn't you? At one point in your career?
We did. We were a preferred developer. Thanks for having me on your show. Good to see you. We're based here in
Good to see you. Good to see you. So now what are you up to?
Dallas, Texas. And I just finished a lunch from the city of Allen. Their EDC had a huge lunch today, and it's really, really booming. They highlighted all of these office projects going on and a lot of new development. We're working on a 6-acre development in Bonham, Texas, that we're working on some pad sites out there. And then, the general Dallas market, we had a lot of salad and goes that all went out, and driving around, those are being taken, as we heard, by Dutch Bros. And the one by my house is getting a Rita's. And so that's doing well. But I see the you know, we also work with a lot of sellers who own the triple nets. And as you mentioned, the political realm or kind of what's going on, they used to buy, you know, sell, buy, sell, and all of that. And a lot of my clients have really put their 1031 exchange or their properties on hold and just collecting the rent from tenants. And every time I call them, they always tell me they have nothing, you know, they can't find anything to buy that they feel comfortable with the tenants that are opening with the low, some of the cap rates going on. But we're still booming here in the, you know, DFW market. When I moved here 30 years ago, it was like 3 million people. And now we're like 9 million people. So, but it just keeps going, spreading out to these communities.
So 300% increase. I think one of my questions, what area of the country is, you know, booming the most? From my standpoint, when I was at ICSC, everyone there was from Florida and Texas. There was nobody from California. So I don't know if you guys saw that same phenomenon. Go ahead,
So
Jesse.
Chris, so just to give you some detail on kind of what I'm seeing on a more national scale from a development perspective. Right now in Oklahoma, I'm working on a Walmart ground up deal.
Okay.
And that's actually directly across from an existing store. So I'm not a developer, but I just, you know, I was working on some other deals. I saw Walmart looked very old. I have a client that was developing in some, you know, states regional to that. And I called him up and he's doing Walmart deals. And I said, hey, do you think Walmart would go into this site? The store across the street, which I had been into, was like crazy, small, old, dilapidated, cracking floors, like super narrow aisles. And so we put the deal together. It's about a 24-acre site with out parcels. And I know they're doing like 4 other stores with him right now, kind of similar to that, where at a 25 acre site, some in Florida, but kind of in the southeast, south central. And I'm sure they're, you know, Walmart is an opportunist as it relates to the sites that they're doing, and you know that they're keeping their options open in markets that they are doing well in and markets that they want to be in. So, you know, that to me was interesting because
that is interesting. You know,
Yeah.
I just wanted to comment because recently I put in AI. I went into Google and I put in what are the tenants that most people want in their net lease properties. And the number one that came up through the AI was Walmart. They said that was the hottest tenant that they would want to buy into occupying a net lease property. Do you see
which is hard because they own they control they control the assets. I mean, Walmart is the end buyer for the dirt and the developer is, you know, essentially getting the pieces around them for, you know, so it's, you know, there aren't very many opportunities to buy a Walmart, and when, you know, when there are, I'm sure the DSTs are, you know, a very high likely buyer for those type of deals. I haven't seen too many of them, but I'm not, you know, looking at DSTs very often. I've worked on, you know, some Walmart deals here and there. They're not the easiest net lease to sell. I mean, sometimes they're, you know, behind a mall and you have to kind of, and the malls are all, you know, struggling in a lot of cases. And so it's case by case. Is the Walmart going to stay back there? I mean, they're powerful enough to, you know, attract a lot of people to wherever they are. You know, I've seen them on mountaintops in West Virginia and, you know, but is Walmart going to move? Are they going to be opportunists and find a better location, right? You know, that's not on the beaten path. So I think, you know, I think that Walmart is very hot, but they're also very limited.
Do you see, this is for Jesse and everyone, do you see Walmart, are they doing that was the nice thing with Walgreens at one point. They were doing a lot of build to suits. They seem really, really developer friendly. Whereas Walmart, they're doing more owner occupied, kind of like Target. They're not really doing as many build to suits. Now I know CVS for a while there was building all their stores and they would do a sale lease back with like Staubach and Staubach would go get a CTL loan and what are you seeing with Walmart? Are they developer friendly, agent friendly, or are their cost
Walmart
of
friendly.
capital? What's that?
I mean, look, like I said, they're opportunists. I mean, their expansion. This is the type of market where a lot of vultures are out buying the deals that are out there as well.
Uh-huh.
There's not a very deep bench in terms of buyers in this market. There's depreciation buyers. There's some 1031 exchange buyers compared to past years. But the other buyers that are out there are looking for real plays, because I think that there is a theory behind, in the next year, maybe 2 years, things will start to, maybe demand will improve, because like we've recovered on a per foot basis from like a sales perspective, but we haven't recovered from a velocity perspective. So market pricing has rebounded, but velocity hasn't. So if you're not priced to market, like within
Okay.
I would say, it's call it 30 to 50 bips where the pricing should be. I mean,
Right.
if you're in like the 30 plus outside of where pricing should be, it's crickets,
Yeah.
because there's
It's
a
great.
lot of inventory. There's a lot of
Yeah.
inventory for every type of deal, and there's just a very narrow amount of quality inventory.
Yeah, it's like getting into that equilibrium, then bang, you start getting some bites. But if you're outside of that area, you're just crickets.
But nobody's, and also think about it, like developers aren't super incentivized to put product on the market right now. So, I mean, they're going to put things on the market where they need, maybe they need the loan money so they can get other deals going.
Right.
They need the loan off their books. But I mean, it's a tough time. I mean, I just we've sold multiple deals. I mean, we had the DGs where the guys had, built to a 4.5 to a 5 cap, and it was a 7 cap market. We had, there's countless situations just like that, or your buyers bought a cash flow stream with a dollar store and the $400,000 to $600,000 NOI per year range, and that's not a number that really anyone's comfortable with. You need, $250,000 is kind of a realistic NOI for a drugstore if they're still going, but like $500,000 is just very risky as a perception. So there's just a lot of tough deals to make in this market and elevated cap rate expectations.
I saw CD rates. So I was looking is like 430. So if you're going into like a 7-Eleven or something, you're about 100 base, maybe 70 to 100 basis points over a CD. So, but if you're in an exchange, maybe it makes sense, right? That's what you're competing with CDs. You can go into a CD at 430 and it's kind of a risk-free, but you don't get the depreciation like Richard was saying. You don't get that bonus depreciation. Thanks, Jesse. Dan Lewkowicz. And then we're going to try to get Matthew back on here. Dan, what do you see the motivation of sellers today? Why are they selling? What is their
good question.
some of the reasons they're selling?
So you have the traditional reasons that as brokers, we've always encountered, like, end of a depreciation schedule or estate planning reasons, death of a family member, disease, some kind of partnership dispute, loan maturity. That's kind of what I wanted to dive into, because today we're dealing with a situation that maybe is a little bit different than what we've seen in the past. All those other variables are still in play and still account for seller motivations. However, today we have, as you alluded to in the beginning, situations where owners are facing impending debt that is going to be either reset at a rate of hundreds of basis points, maybe 200-300 basis points or more higher than when it was originally written, or they're going to have to get a new loan at rates that are 200-300 basis points higher than when the deal was originally funded. So that's causing a lot of anxiety. I still am surprised at the number of owners who kind of close their eyes to the fact that their debt is coming due and that they're going to have to refinance and maybe do a cash in refinance, as you mentioned, bringing cash to the table, or they're going to have significantly poorer cash flow or negative cash flow But it does happen. I think that is a major motivator today. And that's when a simple amortization table and plugging in some numbers can really be sobering for owners to do with their broker when they just realize exactly what the situation is going to be. And I don't see that changing anytime soon. There's a tremendous amount of debt that's coming due, and rates have not really meaningfully decreased in quite some time. It doesn't seem like they're going to in the near term. So I foresee that to be a huge seller motivation point moving forward.
Now, let's say that you're in multifamily in New York or here in California. The government is really tying your hands. Like Donnie in New York, they said that you've got the rent control, but as soon as your tenant goes out, you got to fix up your property to meet all these regulations, but you can't raise the rent. So they said landlords they're not even renting their properties. They figure, I can't meet this requirement. I'm not even going to try to rent the property. Here in California, if you're taking I think it's HUD or government assistance for your tenants, even if the tenant's credit is bad, you've got to accept them, so they can destroy your units. What's the point? I think that is going to lead a lot of landlords that own apartments in California and New York and these states to go to the friendly states like Texas, Florida, friendly states where the government, it really hamstrings the landlords. Do you guys agree, or have you seen any of those?
That's what happened in New York. I mean, that's what's been happening in New York and San Francisco and a lot of other cities where the laws for the landlords of the multifamily product were just very difficult to deal with. They unloaded those properties and they got into triple nets, they bought a lot of DGs and drugstores but now those they kind of found that product type, the net lease, to kind of be a surprise in the sense that they thought it was like owning a residential income producing property, and the rents constantly go up and the value constantly goes up, where I would say that the linear progression of a net lease property is the opposite of that. The value starts here and then eventually reverts to bricks and mortar, which is not bad. You're looking for a coupon. A lot of times retirement, so safety and security has a cost. But with the market shift, it's been a lot more costly than I think a lot of people realize.
Yeah, no doubt about it. If you're a landlord, it really makes life hard, and it's really unfair to the landlords. I mean, I get it that we need to offer cheap rent, but at the same time, it's got to be equitable and fair to someone that's invested a lot of money in real estate. And so what's going to happen in these states like California and New York, people are going to go out. They're not going to tolerate that kind of, and that's the net lease really is a perfect vehicle for somebody that has real low basis in New York or California to roll into if it's completely triple net absolute. So what are some of the deals that you guys have sold recently? What are some of the transactions? Richard, have you sold any net lease properties in the last 3 to 6 months? And were they 1031 buyers? What were the uses of the property? How did the transaction go? Was it quick? Was it easy? Was it hard? What did you see with your sale?
I mean, we've sold fast food, sit down restaurant, convenience, and car washes. Mix of some are 1031 buyers, some are just yield, wanting to buy something to get yield. We have been selling a lot of land this year, and that seems to be a change for us because we're doing a deal. You mentioned Walmart. We're doing a deal with Walmart right now. I mean, we would prefer to be a developer rather than a land seller. I mean, always prefer developer. But with them, I think we prefer to be a land seller. They're just too hard to deal with. Really? Too many hoops. They got head muckety muck of virtually anything you could think of, whether it's site operations, this region. I don't know. I don't think we want to deal with that. We were Walgreens developers for years. In the beginning, that was great. Then it became okay, and at the end, it was not good because they were forcing it, just a fee down your throat, just to be a fee developer. So, these things have a life. They start out and kind of go around the horn, and the next thing what was really good is not so great anymore. So we're trying to avoid that with Walmart. But anyway, the sales have been the traditional stuff. Nothing crazy other than the land sales this year. Just general line retail net lease sales, and they've all been pretty much just where the market is, in the fives and maybe low sixes, depending upon where and what.
Did Walmart, so did they just bought the land and then built their own building? That's kind of like you had land inventoried and then they came to you and said, "I want to be there."
Well, we have land in some markets. We've got land in the Midwest, and we've got some down in Phoenix, in the valley down there. And this was a site that we had up here in the Midwest, and they wanted it. Again, I think we would have rather done some kind of a deal where we could develop it, but at the end of the day, I decided, now let's just go ahead and sell it to them.
Get your money.
We're keeping the out parcels. We're getting some out parcels out of it, which we'll make a little money on those.
So that's where you make your money, is on the out parcels, and just sell the anchor to Walmart and move on. And did they leave some skin in the game for you? I mean, were they tough to deal with? Go ahead, Jesse. What's that?
I said I said it's the out parcels. That's your upside. They're blessing you with their presence, right, Richard?
Yeah, that's where you make your money, on the out parcels. So get all the site work done and all the development done, and that's all on them. And you're going to end up with some out parcels that have value, and we'll do those, and that's how we'll make our money.
Richard, do you do all the subdivision portion of it, like get the separate tax IDs for Walmart and then the out parcels and the REA, or does Walmart kind of dictate all that?
Well, they work you work together. I mean, we just hire
together.
Yeah, we just hire engineering firms and lawyers to do it. I mean, I'm not sitting around doing any of it, obviously, but
so the lawyers,
I mean, we work together. Yeah, let them do it.
Do you split the cost, like a Walmart of the world? Do they inject their pro rata share of that cost?
Well, I mean, it's like any deal. I mean, it's all negotiated. It all depends on what you get. Yeah, they're paying their share on this deal. I will say that.
Okay,
they did fine.
Interesting. Matthew, what parts of the country or specific markets do you like, and why?
A couple different things. So one, I'm a big fan of minority trade areas.
Okay.
Whether it's California and Texas, like a lot of them are the easiest because of the size of them. And the reason that we like them is that the majority of the income goes back into the neighborhood. I mean, I don't know if you've heard last time I was saying it. Michael Millichap was speaking at an event, and we were chatting about, where do people invest? And he says, Pacific Palisades, people making $200,000 a year. Where's the money go? In their houses, in their tuitions, in their cars. He goes, Third and Alvarado, where's the money go? It all goes back into the community. They're not driving Porsches. They don't have Sub-Zeros, and they're consistent customers. When we did the AT&T rollout, when they first came out with the cell phone stores, the high-end areas in Los Angeles and California, the rents were lower there than they were in the Hispanic and other minority trade areas because of the density.
I was in LA for Net Lease TV on tour, and I went to a Starbucks near Coast Highway, and right next to it there was a Latin grocer there, and I went in there and it was
Vallarta,
booming. Yeah, it was booming.
2,000 a foot
What's that?
on average. The Hispanic, the minority grocery stores, whether it's Asian or Hispanic, sales will go from 1,000 to 2,000 a square foot.
Wow.
There was we had an issue, unfortunately, because of immigration and that whole thing brought sales down. But once again, they're buying on Monday for food to cook on Monday, Tuesday, Wednesday.
So the question again, like Jesse was saying and Richard, are they doing build-to-suits, those Latin grocers, where
they're owning
an opportunity to list those properties or sell to other landlords, or are they just owner occupying their real estate?
Majority of them today are owner occupied. I mean, Vallarta, they've gotten large enough to do so. But yet also interesting enough, we just sold a Rite Aid out in the San Fernando Valley that an Armenian grocer bought it, paid $23 million for it. It's an 18,000 square foot old Rite Aid and then some shop space.
Interesting. You know, there's one thing that I thought, like, if you're a landlord out there, really, there should be kind of like for the shareholders, the stock shareholders, you got a board of directors and officers, right, over a company. Really, landlords should have some kind of not a shareholders relation, but landlord relation with the company. I think any landlord, if you're smart out there, you want to see how much debt a company has and when that debt's going to mature and when they got that debt. Because just like landlords, if they borrowed a ton of money in the 2 or 3% range during COVID, and now they're at 5 or 6, they may default on that debt. And yeah, you're going to be going along great with them maybe. And then all of a sudden their loan matures and they can't refinance that debt. Guess what? The tenant's going to go bankrupt. You know, so I think from a landlord standpoint, you still got to kind of monitor the company, and you should really be involved with the company, listen to shareholder meetings, kind of monitor it. Even though it's net lease, I don't think you can just say, you know, let it go on autopilot. I still think you got to kind of monitor the company. What do you guys think?
Surprised. It's so common for an owner to just check out and not even look. I sold multiple drugstores to people and would, recently called them like Walgreens and said, hey, wanted to see how you're doing. If you had any questions. I mean, Walgreens has really had a lot of problems and, it might be worth checking into and looking. And they're like, they pay their rent every month. I think it's for me, and it's like I'll send them a report or something, and I think they just think it's like propaganda. Like, just get out of here with your listing agreements. So, but like I try to, that's one of the things that like in my approach, and I've been selling drugstores for 20 years. I'd be like, this is what's happening. This is why you maybe want to look at alternatives, because like a Walgreens lease had a 25-year flat lease. And then some of them had 1-year options, which is the worst thing you can buy. Something that's just going to fall off like that, because the cap rate just rips upwards as soon as there's like less than 5 years on that lease. There's a lot of other things going on there too that you have to worry about, but some of them just no.
Like Jack in the Box, Jesse, it was at 100 a share. It got down to $7. I was going to try to buy the stock. I thought it was a pretty good buy, but they've got a lot of debt. They've had issues with debt. And what really affected them, I think, is when the Financial Accounting Standard Board said that you couldn't have leases as debt. You had to take it off your balance sheet. So their debt to equity went way up when they said that, when they changed that rule. So they didn't meet their debt covenants. And that's when they went to all the landlords and said, okay, we don't want to give you the corporate lease anymore. We want to give you some other entity. and that's when they sold their corporate headquarters. But it all came down to that change where they said you can't have leases. It's got to be back on your balance sheet as debt, and it really raised the debt to equity on these companies. And so Jack in the Box was affected by that. The one that I heard in the news, Wendy's, I'm trying to remember the guy. He's like I think a hedge fund. They're trying to buy out Wendy's right now. Yes. And I saw Burger King is trying to really make a comeback. But I think times have changed. You really got to monitor these companies, and the officers of the companies. Like Walgreens, the CEO was there and then she bailed out. Maybe she gave herself a big, huge raise, got a lot of debt on the company, and that's not fair to the landlords. What do you guys think? Should there be more accountability with the companies from a landlord standpoint, or do you think that'll ever come to fruition?
Trickle down. It's a trickle down effect. The government all the way down to the businesses. The government. What do you want? It's corrupt.
It's corrupt. Okay. How about Dan? What do you think, Dan?
Yeah, I mean, I think that you have to look at the global picture. Yeah, I think that it's important. It's important to look at the global picture in terms of, like, for example, if you look at the pharmacy situation, I mean, there's a lot of variables at play. I mean, we can go back and have a philosophical discussion on if it's ethical for a company to be able to file bankruptcy to avoid a multi-billion-dollar opioid lawsuit or not. I don't think that's the point. The point is, though, is that it's like the automotive companies in a certain sense. If we have a major crisis where the majority of these national retailers go out of business, and you start seeing, at least where I live, I can't drive more than 2 or 3 miles without seeing at least one closed, Rite Aid or CVS. But if that problem becomes larger and people lose access to, for example, their medical providers, or in this case, the where they fill their prescriptions, that's a much larger issue than just the fundamentals of the real estate and how it affects, the net lease market. So I do think there needs to be accountability, and that we need to approach these situations from a more global perspective, because there is a trickle down effect. And in a case like this, with national pharmaceutical retailers going bankrupt, you can really leave an area without its supply to basic healthcare, which is a problem.
What do you guys?
Not for Amazon.
Not for Amazon.
Not for Amazon. That's true.
For 20 years, they've been slowly rolling out a pharmacy delivery service, and for 20 years, the major pharmacy, Rite Aid, Walgreens, CVS, have slowly unraveled, and the same thing's happening across other. Look at the mom and pop hardware stores and everything else. I mean, it's a conglomeration. I don't know. It's just
right. But at the same time, if you were to take away brick and mortar retail and have everything be e-commerce fulfilled, that would cause tremendous strain on a huge portion of the population. Same thing here. If you were to make everything be mail, have to order on Amazon, right? You need a Prime membership in order to get pharmaceuticals. Yeah, you're really gonna cause a huge problem for a large portion of the population. The majority of Americans do not get their pharmaceuticals online.
Yeah, I'm not condoning it. It is what it is, though. It's happening.
It is what it is. But if you're older, you're gonna want to just walk down there. Maybe your eyes are bad. Maybe you can't.
It's a trust.
You got Parkinson's, whatever it may be. You may not be able to get on the computer. You're so
Seriously.
elderly.
Yeah.
So you need somebody to go to the old-fashioned pharmacy and get your stuff. I get that.
Chris,
one last question that kind of transition. What tenants do you guys see the most supply of net lease that you think are really good, strong credits? Can you do any of those?
Man, I don't know. Is that an oxymoron? I look. There's a lot of Dollar Generals. The cap rates are so low on all these that it's not for like the average person, right? Dollar General is within reach, but is it that good? I mean, the tough thing is like you got a tin can in the forest sometimes. Like, is it good? Can you rent a boat? You know, a guy use it as storage later on. Yeah. You know, are you going to get what you going to get anywhere near the NOI? It's just there's a lot of them. So it's but like you got to really dig into the locations. Just like remember we worked on Sierra Vista and Bisbee, Arizona, which were both Dollar Generals, and one of the store's locations was tremendous. You did like a flyby, and there's just all these cars, and it's like 4 lanes, and then you did Bisbee, and it's like, is this gonna even be a thing? It's but the thing is they were doing really well. They were doing the other component is they were doing really well because there's no competition for like 20 miles, 30 miles in any direction. So then that might create a false sense of security for some. You can buy it and maybe it stays for 30 years and you're great. And maybe they leave after 15 because they find a better spot. That's that's the hard part about some of these assets.
So you just really got back to the intrinsic value of the real estate. Not only that, but also the credit. You're saying
future technology. There's all these different things that you don't know what's going to happen. Like, is it going to be cool to live in a desert? Is it going to be more rural or going to be population focused? I mean, it's just there's all these factors into 20 years, 15 years that you have to no clue what's going to happen.
This guy called me the other day, and he owns a lot of real estate. And he says, I want to show you something. I said, okay, great. So he shared his desktop and he designed this AI agent, and it actually went out and it found me somehow, but it would tell you, the AI agent would tell you, is this a good net lease or a bad net lease, depending on these criteria that he came up with. I thought that was pretty interesting. Have you guys seen anything like that? The guy had a pretty interesting thing. What
did the AI? What were you seeing the AI find? What was it saying? Just said it.
Some of the deals it said were great.
Okay.
Some of the deals it said they were bad. So so I don't know. The problem. Did
you agree or? Wow, come on, Chris. Next time
I don't know. It was a little negative. I'm more.
Well, he offered to finance it.
It was just way too logical, and it didn't really look at all the variables.
I'm with the Pope on this. Never trust the AI.
That's what I said. It's like it's good, but I don't know if I would completely
never trust the AI. It's not.
I think human premonition is better than AI at the end of the day. I don't know if you guys agree, but I think the AI is still pretty high. It's a little bit.
I guess if you have a premium subscription, then you probably could trust the AI. But otherwise, just never trust the AI.
Chris,
is always wrong.
Yeah, go ahead, Matthew.
I would say the AI. I've been using it, doing some OMs, and when you ask them to do a retail tenant map, it's amazing how many tenants all of a sudden are flocking to that one site.
Now, how did you do that? Wait, explain that.
What I'm saying is the data is not accurate. I mean,
it's still not accurate.
It's not. I mean, it can give you some good context. I mean, that's what to me, what all of our brochures were missing was context. Here's the address, here's the square footage, here's this, but there's no context to really analyze a property. So now with, in fact, if you haven't used Crexi is tied in with AI pretty deep now, and they'll give you some of the area information, some of the background. Is it? I feel not. Like, you can't rely on those things.
I feel like AI is a subscription gimmick. I signed up for an AI cold calling thing. I had never had a worse month in my life. It was fast. It was. I was like going 100 miles. It was insane. It was like calling all these people, but it wasn't super organized. It was doing it, and it was like leaving messages for me. So I wasn't missing a beat, but I need a little space in between the conversation, apparently. Like I need that moment where like 20 people don't answer, because this rapid fire cold call thing was just, I don't know, maybe I'm old fashioned, but it was
human interaction. At the end of the day, people want human interaction.
that
it was a lot of humor. It was like being in New York City and having to have a 30-minute conversation every call. Like it was,
It's
and
like
on
you're
top of
dealing.
that,
It's like you're dealing with the Tin Man and the Wizard of Oz. You know, it's mechanical. It's like it's
yeah,
kind of
it
Frankenstein.
needs some
People
time.
want
It
to
needs
deal
some
with real
time.
people at the end of the day,
They
right?
need to. I just think they need to figure out like how to utilize it in a organic way that actually helps and that the data is correct, because it's a lot of the data is not correct, and a lot of the the products that are being offered just aren't super helpful. They're kind of I don't, I
Yeah.
don't know.
You got to humanize it, not automate it.
You know, I think in Asia, like in China, they said that people are more adapted to the AI. I don't think we're really completely accepted it all yet, but we'll see that, you know, some of it is a little bit hype. You know, these stocks, they're all going up. At some point, will it be like Y2K? Everybody just says, you know, this is a little bit, you know, kind of like that. What was the story? There's a little boy there, right? And the king is naked, and nobody realizes it till the boy says, "Look, the king's naked," and then everybody is like, "Oh my God, he is!" You know, we'll see if that happens. Anyway, I'll leave you guys on that note. Richard,
All right.
if there's any tenants out there that want you to build for them, how can somebody from corporate contact you?
Oh, it's easy. You can come to our website, hurdrealty.com. You can call me at, my phone number's on there. I mean, this is our 45th anniversary this year, so we've been around a long time. A lot of the companies that we work for know how to reach us. We don't tend to have a reach to companies that are big in the Northwest or the Northeast, but the middle of the country and the Southwest and Southeast, we have a halfway decent connection to. So those are the areas that we like to work in. And I find it's easier on my stress level to deal with companies that are basing in the middle of the country than the ones that are on the coast, generally speaking.
Interesting. And how can somebody contact you, and what are you kind of focusing on? Like, what would you, from a principal standpoint, are you looking for listings? Are you looking for buyers, sell leasebacks? What are you trying to engage with at this point?
Yeah. So thank you. First of all, I'm very active on LinkedIn. I try to put out as much valuable content as I can. So you can definitely find me there. You can also reach me on my cell phone, which is 248-943-2838. Again, 248-943-2838. I mean, most of my business is, owner representation in terms of, from an investment sales perspective. I do represent buyers, especially if I've worked with them before. And oftentimes on the properties that I list, I end up selling to a buyer that I know. So really, I mean, that's the bread and butter of my business, like it is for most brokers, is listings. I focus on single tenant net lease, shopping centers, single and multi-tenant medical office as well, and all over the country.
Dan. You're really articulate. I love you as a guest. You're such a good speaker.
Thanks for having me.
You're always a great interviewee. Jesse, how can somebody access you?
Call me on my office line, 212-430-5291. I'm fairly reachable. If you're in the commercial real estate industry, I'm probably emailing you. Maybe. I don't know. Good chance. But look, happy to help with any type of net lease deals, and as well as doing a lot of dark and vacant stuff. So I've been working with a lot of developers on that type of product. Shopping centers and other retail oriented product.
And I want to just tell you, I work with Jesse. Jesse came to my house at ICSC San Diego.
We went surfing.
We went surfing. And one thing I know that I like about Jesse, working with him, when he says he's going to show up, he shows up. You call him, he answers his phone. Today to get that is like, you don't really see that. He's very dependable. If you need him, he's got your back. I really respect Jesse. for that reason, because I've dealt with a lot of people and there's not many people like that out there. So if you have him as your agent, that's really important. You want somebody that you can get in contact and is going to have your back, and very dependable guy. Jesse, you look a little confused, but that's what I found dealing with you. I really respect you, buddy. And
surfing,
you're
yes,
a good
confused.
surfer too.
Not you. You're Chris is an amazing surfer.
Thanks, Jesse. So Pam, how can someone reach you? Are you going to be at any events coming up? How can somebody reach you?
Always reach
what
me.
What are you trying to get? Like, what is your future? Are you looking to develop? Are you looking to represent sellers? What are you up to?
So you can find on our website, pamgoodwin.com, for all the properties we have listed. Send me an email at info@pamgoodwin.com. Just focused on some of these smaller communities here in Texas on the development side that we're doing ourselves. I know Richard mentioned Omaha, Nebraska. That's my hometown. I feel like it's doing quite well development. So I'm looking at property in Gretna and some of the suburbs of Omaha that are really doing well. But we primarily, on the triple net, we mainly work with sellers that are selling their properties is what we're working on. And then I'm just focused on, I'm doing a lot of teaching my real estate courses on how to invest in the triple net properties.
Nice. That's awesome. That's really good. People need more education. Really, they need to be educated to go into these deals to make good decisions. Because, if you aren't educated, you go into the wrong deal, it could be a nightmare.
Right.
Jesse and I, we have various clients where they didn't do their homework, just kind of went in emotionally, and you're going to pay the price. You're going to stub your toe.
I know Dan mentioned why people are selling, and I have two recent ones where the principals passed away and now working with their estates, and it's a big education for their, they have no idea what their mother or father left them in real estate, and educating them and finding the person to trust, to sell it or hold it or what to do with the asset. So I'm in that been at it for 35 years. So now, going on these days.
The one thing, if they're with a short lease and then the heirs get it, now they were getting the income. Now they got to re-tenant a building, and that could be a pretty tough thing on somebody that doesn't have much development experience and not much cash. They could be really scratching their head. What do I do? That they really need a lot of advice. Matthew, how can somebody reach you?
Easy. Email is matthew@mra.la. Nice and short. Phone number 323-620-9845.
Thanks, Matthew. So from my standpoint, rates right now still kind of the same. I mean, I think we're looking at like 5.5 to like 6 5/8 on a 5, 7, or 10-year fix with like a 25 to 30-year AM. And we've got the swap pricing. Like we did a 7-Eleven with gas on swap pricing, right around 5 5/8. I think it was to 5 3/4, and that was a 530 in West Palm Beach. I did a 7-Eleven a couple months back. One thing that we're seeing a lot of owners are going for and buyers are the floating rate debt. Our floating rate debt right now is like 5.5 to 5 7/8, and there's no prepay or real friendly prepay. So if you don't know what's going to go on with the politics and the midterms, that may be a good option for you. You get a no prepay deal. If you want to roll out of it, you don't have a prepay. If you see rates start to drop at some point, then you can refinance into more of a fixed rate, and that gives you a lot of flexibility. So you can reach me, Chris Marabella, on my cell, You can always call me 760-803-6464 or just jump on my website, www.marabella.finance.com. Kind of like we all talked here, I would love to meet you in person. I don't want to just be AI, okay? I want to meet people. Our business is all about relationships at the end of the day. So I've got the office here in downtown San Diego, Carlsbad, Beverly Hills, Costa Mesa near South Coast Plaza. I want to sit down with you and get to know you, spend a day with you if you're a principal, because that's where we're going to be most effective, building a relationship, and we're going to be able to help you versus just transactional. I don't think anybody here is really into just doing, one-off transactions. We really want to form a relationship to help you out and to educate you to be successful. I want to thank you guys for being on the All-Star Net Lease